starring none other than Vishal von Kirstenhoff from
Yeah.
Art Basel.
We are planning a wedding after getting engaged.
The skill with which you can architect those sales really matters.
My grandfather said, Michael, always leave a little bit of value for the next person. If you sell out early, are you giving up all the upside?
I still hear people pitch Southeast Asia like it's a big market. I think the sophistication of the way an LP pick a manager has to be above the 3 or 4 slides you always see in every single pitch deck. We're gonna start recording.
But
Loosen up and be happy. Welcome to the first remote Unreasonable Podcast, starring none other than Vishal von Kirstenhoff from Art Basel, so Michael Blakey from the UK, and myself from Singapore, Hien Abeng Go from Open Space. How are you guys doing today?
glad we recorded this one remotely, guys. Otherwise, we'd have to wait an infinite amount of time to get these episodes out.
Oh
And
man,
I'm glad to be back. I felt like you deserted me. You went ahead and did a podcast without me because I was traveling. I'm like, wow, there's love for you.
It was.
I hope the other guy wasn't as good as me.
It was to the point.
It felt different.
There was no rambling. It was an incredible recording. You were missed.
Yeah,
I was missed.
you were missed. Yeah.
I love you guys as well.
Michael, where have you been? Where are you now? You're in the UK? What have you been doing?
I am in the UK. I have been doing way too much traveling over the last couple of months, having to talk to a lot of my current LPs and future potential LPs, raising my next fund, which, as you'll all be happy to hear, I am finally charging a management fee. I will
Congratulations.
I will finally pay myself a salary. I realized that I couldn't actually hire, nobody else was willing to work for free. So I actually have to pay people. But I'm still sticking to the point that I'm the lowest paid person in the fund.
A little bird told me that you're planning a wedding as well.
Oh yes, well, I'm trying to avoid that, but yes, we are planning a wedding after getting engaged. So obviously, with all things, it's all about communication. We have different wants and different needs. So as per usual, I'm putting up the fight, but I'm more than likely going to lose it.
I'm pretty sure Maria's gonna let you have your Pringles buffet.
I that's probably the one thing she won't let me do. Like she whenever she sees a Pringle package, it's my favorite snack.
Michael Blakey biting off more than he
Sponsored
can
by
chew.
Pringle. So Pringle, if you want to sponsor,
Yeah.
so Pringles,
Why don't
if
you
you're out
move
there doing
house
this,
and have another kid at the same time, just to make 2024 even more interesting? Oh my God.
life is dull.
Vishal,
otherwise.
where are you broadcasting from?
I'm in Seoul right now, but the week before this,
Are you
I
not
was
in Basel?
Basel in Hong Kong for a good week. So many conferences taking place, one after the other. We had like the One Earth conference, the Wealth for Good, Milken, Fortune Innovation, Monaco conference, and the craziness of Art Basel. All those friggin' parties.
Was there any venture capitling, in between these things?
There was some venture capitling. I got to meet two really cool dudes. I got to meet Tyler Brule, the Monocle
Tyler,
personal hero of mine. I love their freaking. I have one right over here next to me, actually.
I do.
For Monocle, but love their stuff.
That's fantastic. Okay, well, I hope to see you when I come back.
And here, from the sounds of things, you're still in Singapore. So for once, you're not in Dubai. You're actually at home, right?
I'll be going to Dubai soon. No, I did Chinese New Year, and then I went skiing in Niseko. Hey, so Mike, how's this fundraising trip been going? What are the common questions you're getting about Southeast Asia?
Yeah, it's actually going really well. It's tough and it's really tough out there, but it's interesting. Like the theme, I'm getting a similar theme. Doesn't matter if I'm talking to US, European, or Asian investors. There's one kind of main theme that I keep on getting kind of challenged on and talked about, and that's they're talking about like the opportunity of Southeast Asia.
Yeah.
LPs, family offices, fund of funds, all are looking at on the whole more of a global market, and they're seeing is Southeast Asia and Southeast Asian funds are massively underperforming their peers. Yeah, they're not even kind of saying it's close. So there is a lot of cynicism around kind of the opportunity of Southeast Asia, and do they just believe that it's not going to be there? This is not the right time, and especially now, a lot of them are really focused on DPI.
Yeah.
A couple of people just turned around and said, Michael, like you've got a DPI, but similar vintages in the US have got twice as good as yours. Why shouldn't we just double down on them? and put more money into you.
Hey,
So it's a really interesting conversation to actually have.
But at the end of the day, it's also because the entire asset class has been waiting for many exits. We've had companies IPO, right? We had Grab and Gojek IPO, but then those share prices have dropped significantly. So people may not have sold down, or if you had come in at the pre-IPO, you would have lost money. So that I think is just a way for your investors to say, we're not making money in Southeast Asia. We're not making real money. And if we've invested in a fund, the funds are telling us that we've made money for you, but I'm not seeing that money come back.
And
So
also, I
it's
think
really
they're
down to the
also,
wall, right?
but I think it's also they're also not seeing the same volume. If you go to the US, you can be talking about hundreds of companies that potentially are going for IPO or going for exits every year. If you look at Southeast Asian as a whole, how many exits are we actually seeing each year? That number is not huge compared to the comparables in China, India, Europe, and the US. And we're kind of like the poor fifth cousin of those other regions or countries. The way that I argue for it is actually that this is the time to be actually doubling down in Southeast Asia. Those markets on the whole are a lot more mature than ours, and I still remember back in the kind of early 2000s when we were having similar conversations in the UK about where are the exits, why aren't we making money, where the VCs aren't performing and everything else. And you now look at it 15, 20 years later, we're not having those conversations. And I think we're in a similar kind of stage where I think the market is proven. I think the groundwork has been set. The foundations have been set for Southeast Asia. We've got a few kind of like early winners, but the companies over the last kind of 5 years plus, which have been funded or which are gaining traction, I think these are going to be good. But I think actually the key vintage is actually the next 5 years. And I think it's going to be because of multiple reasons. I think one is valuations become much more realistic. I actually think the basis foundations of success has been
Oh,
done in
been laid
Southeast
down.
Asia,
Been
yeah.
laid down. Yeah.
have been laid down. I don't think we've had success. I think the foundations, and part of that is it's got to be like the Wild West at the beginning. You've got to have a lot of people throwing a lot of money, making a lot of dumbass mistakes. There's going to be a fair amount of money is going to be lost. So if you look at it from a VC perspective, there's going to be a lot of funds that are not actually going to actually deliver any returns to their investors, which kind of happens
Yep.
globally. But I think it's going to be very distinct here because it's such a small market. But they've invested in founders. There's been a lot of learning. So the ones that are successful are going to probably be going to perform much better. There's going to be more founders who've had experience, and quite often it's not first time founders who have the big successes. A lot of successes comes from founders that have done it once or twice, had the learnings, and then gone on to be successful.
That's an interesting
Governments are
thought. We should
figuring out.
hold that. We should hold that thought
Okay.
to talk about it later. I'm curious what Vishal has to say about this Southeast Asia, Hustenberg, Vishal Harnal
Yeah.
Hey,
from
look,
Europe.
I'm investing in the market. It's a huge part of our practice area. We've had many, many funds that have invested in Southeast Asia as a market, but we're coping with the realities of what it's been like to invest in a new and emerging market across the world. My thesis on this is people think that the tech opportunity is equally global everywhere, but I don't think that's true. I think that there are a few very large markets and there are many smaller markets. And the reality of Southeast Asia is we like to think about it as this homogenous chunk, but it's not really a homogeneous chunk. And so it's unfair to benchmark it against the US or China or India. And the trouble with the generation or the first generation of VC and even of companies is that we've been benchmarking them to Chinese, Indian, and US tech companies. But TAM is a lot smaller. Unless you can push these companies to be global companies, it's very hard to get over there. Purchasing power in Southeast Asia is a lot lower as well, and the exit avenues are also smaller. But can you make it a successful tech market? Yes. It's just that the physics of Southeast Asia as a market are a little bit different. And so, this next generation, I think, of companies, especially the ones that we've invested in, all of us have invested in the last 3 to 5 years, the way we've invested in them, the valuations that we're setting, the care with which we are looking at the exit potential of these companies and how we're benchmarking them is now very different from the heady years of 2010 to 2020. And that's what's happening in Southeast Asia right now.
I wouldn't say the heady years were 2010 to 2020. I think the heady years were 20. 19, 2020, 2021. I mean, you were there in 2013, 2012 when we were doing this.
Yeah, just
It
getting
wasn't
started.
even like, yeah, it wasn't even like, do you have any DPI? People were questioning, can you actually create startups? I think that it's absolutely the correct question to ask at this market cycle. A lot of funds have been doing this for 10 years. And you have to look at that vintage of funds. Grab came out, Gojek came out, a few of the others are there, but that's, an Indonesian story. But if you look at the next generation of companies that were funded, say, call it 2013 to 2016, they're decidedly more regional. You've got Karo, Karsam, you've got various things, you've got the Indonesians as well, you've got a couple of deep tech companies probably going to come out of Singapore. And these companies cannot get to either exits in the public markets because they're not that old yet. So, yes, investor patience is getting tested. But if you look at it from a vintage by vintage perspective, the vintage of funds that are, say, 2014 to 2017, they need to start delivering on their DPI benchmarks. And there are some funds who have delivered on their DPI benchmarks, say from 2009 to 2013.
Right.
So that's what I tell investors, that what then confounds LPs, and I have to say this, like, there are some LPs who have significant conviction and they've done the homework, they've gone through the cycles, and they're contrarian. They know that when there is disappointment or when there's lack of capital going to the VCs, actually that means that these VCs do buy these companies at a cheaper price. So it's been shown, like, time and time again. There's these great research articles done in the US where the best vintages in the US are the ones when the markets were down. So I think what's the problem is that maybe the last cycle 3 to 5 years ago.
It's kind of also in the very selfish interest of every fund manager to say that, because down markets are also the
Yeah.
hardest time to raise.
Well, you see, we've gone through.
Research, it's true.
But historical,
No,
it's
no,
a
no,
historical
no,
fact
no,
that is
we've
the
gone through
case.
this. We've gone through this cycle. Like 2010 to 2013, the people who invested in your funds were truly people who had an independent sort of chain of thought, or else they wouldn't have done it. And then when you got the excitement between 18 to like 2020, 21, a lot of new people bet on this thing. And those, I think, are the people who are really sort of saying, really, have we made the correct sort of move? But it's really a function of the markets have to return. You look at some of the companies that are at scale now. Have you invested in these companies at, as Michael says, the right price? And there will be managers who will underperform. And I think there'll be a shakeout because, whole of Southeast Asia will only be 10 years. So, it's not easy to convince people because you can go and invest in many different asset classes. And I think that's what you're getting, Michael. Like, only the truly discerning, truly contrarian, truly independent thinking LPs will say, you know what? I'm going to diversify. Not going to give up on venture, and I'm going to pick good managers with very, very identifiable, authentic strategies, right? And believe that they will deliver.
I think the second part of that, the problem that they're struggling with is there aren't that very many. There's hardly any fund managers who've actually delivered anything of note.
Okay.
You're literally looking at a handful.
I'll
In
tell
terms
you.
of one of the things that they do like is if you've got a very clear thesis that makes sense to them. And I think a
Yeah,
lot of people are just going saying, "Hey, we're a VC, give us money," and they're doing the same story. They're
exactly.
saying, "Hey, we're active," or "We're
Exactly.
doing." They don't actually have a clear strategy in terms of how they're actually going to deliver a
Yeah.
success rather than just being an index fund.
Yeah.
So for me, it's, even like one of the things they do like is when we talk to them about what our exit strategy is, it's a very clear one. It's not actually IPOs. It's not even like trade sales. It's to do with secondaries. We're coming in pre-seed. So we're coming in average valuation around like 2.5 million. We're coming in. We're saying to them, look, when the company gets to 100 million plus, or as soon as we've made over 15 times the return on the original investment, we will then, whenever they do a funding round, look to do a secondaries, like 10,
That's a
20% of our
legitimate
stake
way of making money. That's a
is
legitimate
is
way of
making
making
money.
money.
We can still make the returns. We'll let the majority ride, but we are bringing in returns a lot faster because companies are can scale a lot faster. I believe in Southeast Asia, they like that as a strategy, and their thinking is that a lot of people are waiting until the very end to get there, and so their frustration is a number of the
Yeah.
funds they've invested in into these big companies have never taken any money off the table.
But then I still hear people pitch Southeast Asia like it's a big market. There's like, 300 million, 400 million, 500, 650 million people once you add it all together. And I think the sophistication of the way an LP really needs to think about Southeast Asia and pick a manager. has to be above the 3 or 4 slides you always see in every single pitch deck. And this is the first time, as a bunch of investors, we've had to tell a story beyond those 3 or 4 pages. Vishal, you look so dapper. You're thinking so deeply.
I don't know. I feel like nothing Michael shared is new to me. Everyone says that they sell down in secondaries. I don't even think that that's a differentiated strategy, to be honest with you. So I think that like anything that we are pitching to LPs now is no different than anything anyone has heard before. The story is the same. I
Hmm.
think what's really different about Southeast Asia right now is that there was this class of VCs that we are also a part of that did not really understand how to do things, that learned the ropes through Fund One, Fund Two, and Fund Three, Fund
Yeah.
Four, the ones that are right now. Now is where we're really getting into the art and craft of venture. The tricky bit is Fund Ones and Fund Two are the funds in which you're going to be benchmarked and driven. And honestly, given the current macroeconomic in which and macroeconomic environment in which those funds are hitting maturity, it's a hard environment. So just when you're getting into the hang of things, into the swing of things, the market turns and makes it a little bit hard and difficult to actually raise real capital. And I think that's the reality of the narrative right now. At the same time, LPs have choice, and LPs are much more sophisticated than they were 10 years ago. They understand how to benchmark funds globally against, and pools of capital are global as well. You have choice and flexibility in deciding where you want to allocate it towards. So you've got to make the case for why it must be Southeast Asia. I'll tell you one of the big changes I've noticed, at least, and it's something that is my mantra now for a few years, which is that companies are bought and not sold. So sorry, companies are sold and not bought. And what that means is that we used to take for granted that exits would happen. We used to take for granted that the next one was going to take place, that the company will IPO, that the company will have a trade sale. Those were things people assumed were going to happen in the natural course of the physics of the startup journey in life. But that's not the case. In harder markets, that isn't the case. And even in good markets, the skill with which you can architect those exits, architect those scale, the sales, sorry, really matters. And I think that's really what has changed right now, which is an aggressive and
Yeah.
active hunt towards doing that because, drum roll, DPI. Investors
Yeah.
want to
No.
see their money back and they want to see that you can make it happen as art, not that there's this escalator and I'm just going to pass it on to the next chump and that's my strategy, right? I think that that is definitely one part of an overall strategy in how you exit companies, but they want to see that there's a craft towards it, right? And I think that's what everyone's learning.
I've always said, like, there's a difference between value creation and value extraction. You can make a great company, but if you get squeezed, you don't extract it. Or if you have a company that's just in the right sector and you know how to flip it, you make money. So I think one of the things perhaps investors feel like it naturally come. I totally agree with you. I just we've never taken that for granted. I mean, I know Vishal is like, oh, yeah, I'm saying this always. But no, we've really never taken it for granted. And the reason for that is because I went through it really badly. Like Asian Food Channel, I had somebody tell me, it's like, when it's time that people are interested in your company, that's the time. You can't say, no, wait 1 or 2 more years, or, I don't want to, I want another price. That's the time people are interested. The corp dev department of that media company wants to buy a company. That's the time you exit. And you have to be very conscious and you have to work with founders and you have to say, this is the window. I'm so sorry. This is the window. Or congratulations, this is a window. We got to go get it. Yeah.
I had an interesting conversation with a VC that was looking to one of my portfolio companies. It was a VC out of Silicon Valley, and the founder is very clear on that exit. They're like, the next 3 years, this is what we're going to achieve. And when we hit that, this is where we believe the value will be. It's going to be a huge return for everybody. And they're very clear, like very structured thinking. And then she called me up and said, look, we're not going to invest. And I was like, why? So he's looking towards an exit. Like if he's saying there's a big opportunity with the type of fund we have a much bigger vision. Yes, 500 million, $1 billion might seem a lot to the founder, but we're looking at global game changers, which are going to give a much greater return. We don't like the founders actually even thinking of exit at this stage, which is kind of around like a Series A. So I agree that we I think as the investor, we've always got to be mindful of what, even when we make an initial investment, we're always asking ourselves, what is the potential exit opportunity for this business? But for founders, I think a lot of the time, especially in the early days, they've got to be very much looking at growth and execution. And only at a certain time do we actually start bringing into the conversation, when we think they should actually start considering, an exit
That to
opportunity.
me
But
is like why. Yeah, go ahead, Michael.
no, I was just going to say, I was just going back to something like Vishal said. It's like, yes, secondaries is for me a very obvious exit, and people might say it, but the reality is people haven't been doing it, because if you look at the DPI of majority of funds, it is literally a handful of VCs in Southeast Asia that have actually got any DPI, anything. You can say that people talk it, but nobody's actually been doing it. And I think that is where the issue has been, is there's been a lot of value
I
created
agree with
over
that.
the last like 5 or 10 years, but people haven't been taking advantage. People have been greedy, which is exactly what, and I freely admit I did when I started in 2000, is I was like, I'm here till the very end. And my grandfather, like, he said something to me many years ago when I first started out, which kind of really came home to roost. He said, Michael, always leave a little bit of room or a little bit of value for the next person. So, because you have that whole debate, if you sell out early, are you giving up all the upside?
Yeah,
And I think the thing
yeah.
is I'm not saying sell out everything. I always say, look, guys,
Yeah.
what goes up can come down. And if you've got a good value compared to what you entered into, take some money off the table. At least return what you invested, maybe a little bit more on top. Let the rest ride, and then each stage, yes, you give up some of your upside if everything goes according to plan, but 9 times out of 10 you don't. And it goes back to your LPs. Doesn't matter. I go to them and say, look, I'm a deep tech pre-seed fund. You're not going to see an exit for like 8 to 10 years. And they're like, yeah, Michael, we understand that. And I'm sure you've all had the conversation. About 3 years in, they're kind of like, hey, Michael, when are we going to start seeing some money come back again? And I'm like, we're a pre-seed deep tech. Like, we're investing in nothing. And you're asking me that question.
Remember that conversation
Yeah.
then?
It's very short-term memories they
A
have.
moment when you with my
So this
grandfather.
is somewhere you can give it to them.
Go ahead.
So no, I was just going to say this is something that for me we've kind of thought about a lot, and it's an interesting dynamic in Southeast Asia. And I guess going slightly off topic, but where I have a great concern for Southeast Asia, like my biggest concern is, and we've debated this before, is I still don't think there's enough early stage VC funds in the region. There's too much money comparatively at the Series A than there is at the seed. And in terms of a
Yeah.
volume play, that there's always got to be that kind of pyramid. You need 100 companies invested at my stage.
So
Yeah.
number one right now, I'm seeing in the market companies that are profitable, but their last round
Mhm.
valuation perhaps is a little bit too high. And then what we do is we go look for secondaries, and that represents an excellent DPI opportunity for funds um, who could be Series A funds who invested earlier or seed funds. And I think that's a legitimate exit strategy. That's number one. But number two, we were lucky where we had a couple of companies go all the way to IPO, right? And we were offered the ability to exit at size even before IPO. You know what we did? We asked our investors, our main investors, and said, if we took money off the table now, this will be, the anticipated IRR of this investment. If we let it ride, this will be the anticipated IRR. So what would you think? And in the one LP that I really respect, right, is a US endowment. And they've done this many, many times. They said, Ken, take some of that money off the table and we will factor in the fact that you have given up some of that potential IR and we're not going to blame you for it. And thank God we did that, right? So I learned from my LPs. If you're very lucky to have sophisticated LPs, who really want to benchmark you and get you started in the business, they'll teach you how to do the DPI thing in the first place.
It's true. I think no one's going to blame you for taking some off the table, but for not taking any off the table, that's a tricky one, right? It's like a damned if you do, damned if you don't kind of situation. So the middle road option is always, I feel, one of the less controversial decisions that you can make as a fund manager in a situation like that. I think when we think about Southeast Asia as a market and we think about what the future of that market is, I'm optimistic, but in the milieu of what I said earlier, which is the fundamental physics have changed on how we size this market and how we invest in the market. But I'm optimistic because the fundamentals are a lot better. If you think about it from every sort of metric, whether it's internet penetration, e-commerce penetration, online banking penetration, all of those things, right? Just number of internet users and everything, it's just exploded over time. The familiarity of founders with building companies in the ecosystem has grown over time. All of this stuff has been built out. So the question then is, how do we take advantage of it? And how do we ensure the longevity of that ecosystem, even with what's happening right now? And how do we write it out as investors and and founders in the ecosystem? And I'll share something with you. And I don't actually feel like there's less early stage capital in the ecosystem. I used to feel that way. I don't feel that anymore. I think that there's enough. It's just been taken over by angels as opposed to seed funds, and they've stepped in to fill in some shoes. So there's a lot of funding happening at the early stages. It's just not from institutional VC. But what I do think has happened, and I'm very worried about this, is that investors are dampening down the ambitions of founders, and founders are becoming a lot more ambitious, less ambitious based on what investors are saying. And I'll give you an example of what I mean. There's this narrative now: sustainability, profitability, growth, that is slow and steady and not growth at all costs. And so founders, and when they think about building the companies that they want to build, you naturally dampen down your ambition significantly to meet this slow and sustainable growth idea that they think all investors want to hear. Investors want to hear about profitability, even at the seed stage, pre-seed stage. The tricky bit with that is that that's not the asset class we're investing in. We're not investing in slow and sustainable growth from day one. It's not venture. That's something else altogether. That's a go to the bank and get a loan for a fucking SME, right? No, no, SMEs are great. I don't mean it in a disparaging way, but it's a totally different asset class. In venture, you need to at least have the big ambition to fill it out. And the path on how you get there and how you build the big but sustainable company in the longer run is something that you can have. But I worry that ambitions have just been drummed down. I don't know how the two of you feel about it.
I don't totally disagree. So I partially disagree. I'm going on the fence, kind of. Look, I think in the first part, I disagree in terms of I know so many founders that when they started their business, they were based here. When they started their business, they've actually either moved to the Europe or the US because of the lack of funding that is available here. And if I look at what is happening around like deep tech investing,
Sorry, you're saying Southeast Asian founders have moved to the US or Europe because of the lack of funding here.
no, no, is how look for people that were based here that even are going after the local market are actually going. I know a number of kind of Singapore based businesses that have gone out and raised early stage
Oh,
funding in the UK and the US because they had absolutely no options here. I know quite a few in terms of if you go for consumer tech, I know there's a lot of angel money going in. But if you look at deep tech, and one of my focuses is deep tech, one of the biggest issues at the moment in deep tech is the lack of funding for spin outs out of universities. And the government is struggling to do it. But for me, the quality of the businesses which are coming out, counter kind of going the other way, are actually improving
Michael, I think we've
massively.
had this conversation on a previous podcast. I mean, I totally agree with you that deep tech is definitely underfunded, but it's
Yeah,
its own small ecosystem in the larger ecosystem of VC and tech.
which is true. But I'm looking at it from my point of view is that when we talk about the fact, because we talked earlier about like I think the foundations are actually set for Southeast Asia. I mean, I look at and I'm looking at from a deep tech and a kind of enterprise perspective.
No, but it's good. Like I think, like in general, we're all optimistic. We just have different views on how we're gonna get what's happening right now and how we're gonna move beyond this. But I think some of the most promising signs have been what we're seeing in general happen in the tech world globally. So big tech is again starting to go on a bit of a an upswing, whether it's driven by
Yeah.
AI or other things. It's good. It's good for tech in general globally. The Reddit IPO, Reddit's one of our global portfolio companies, did pretty well for itself. There was a it's still trading above the listing price, so pretty good thing over there. And I think in general, right, like we're hearing some buzz about activity about potential listings in Southeast Asia as well. Maybe not in this year, but maybe next year. I think we've talked about that before, but it leads to us being a little bit more optimistic despite what is happening in the fundraising environment over here.
Look, I think that I feel like we should be summing this up. It covered so much ground today, uh, but the reality is that if you're in it for the long haul, and I know all of us are, we've done this for decades. We're going to see cycles, and we're going to see people be too optimistic about an asset class. And I think at this point in time, people are too pessimistic about the asset class.
I think so too.
And I think if you invest now, you might be pleasantly surprised in a few years' time. But let's see.
Yeah.
Next time we could do a podcast in a country together. It doesn't have to be Singapore.
All right. Let's see whether Basil can make the method out of the madness for today's Unreasonable Podcast.
Exactly.
That's pretty much it. Thank you very much for tuning in to listen to the stream of consciousness of the three of us. And see you next time.